US regulators are reportedly seeking a rescuer to buy First Republic Bank in a deal that could be announced as soon as Sunday. This follows news that customers had withdrawn $100 billion in deposits from the bank in March, leading to concerns about a wider banking crisis. The Federal Deposit Insurance Corporation, FDIC, has asked 6 banks to bid for the embattled lender. The collapse of Silicon Valley Bank, a competitor of First Republic, had prompted fears of a wider banking crisis. Its failure was swiftly followed by the demise of another US lender, Signature Bank. The problems faced by these banks raised concerns about the global banking industry, with central banks around the world raising interest rates to dampen inflation. This has hurt the values of portfolios of bonds held by banks, which were purchased when interest rates were lower. We kindly ask for your support in reaching our goal of 1,000 subscribers. Consider subscribing to our channel to stay up to date with the latest news and help us continue to provide high-quality content. Your subscription would mean a lot to us and contribute to our mission of delivering unbiased and reliable news. Thank you for your consideration. In Europe, Swiss banking giant Credit Suisse also faced its own problems, having to borrow $54 billion from the country's central bank to shore up its finances. Credit Suisse was subsequently rescued by longtime rival UBS. Like Silicon Valley Bank, First Republic is a mid-sized US lender, counting wealthy individuals among its clients. If a buyer is not found, these clients' money is potentially at risk. In the US, the FDIC insures deposits up to $250,000. When Silicon Valley Bank and Signature collapsed, the FDIC stepped in to say it would guarantee all deposits to prevent a run on the bank. If a buyer cannot be found for First Republic, the FDIC may take similar actions. The involvement of JP Morgan Chase and Bank of America in the bidding process for First Republic is of particular note. JP Morgan was among a group of 11 US banks that injected $30 billion into First Republic in March, in an attempt to stabilize the business. It is not yet known if the bank will be successful in acquiring First Republic. The news of First Republic's troubles comes amid a challenging time for the banking industry. The COVID-19 pandemic has led to unprecedented levels of economic uncertainty and volatility, and banks have had to navigate this uncertainty while also complying with regulatory requirements. The increased regulation and scrutiny faced by banks since the global financial crisis of 2008 has also made it more difficult for them to operate profitably. At the same time, the rise of fintech companies has disrupted the traditional banking sector. Fintech firms offer innovative financial products and services that can be accessed quickly and easily through mobile apps, and this has led to increased competition for traditional banks. The rise of fintech has also raised concerns about the stability of the financial system. Fintech companies are often small and may not have the same level of regulatory oversight as traditional banks. This has led some regulators to call for increased oversight of the fintech sector, to ensure that it does not pose a risk to the stability of the financial system. Against this backdrop, the news of First Republic's troubles will be closely watched by regulators and market participants alike. The collapse of a mid-sized lender could have wider implications for the banking industry and the wider economy. If a buyer is not found for First Republic, it remains to be seen how the FDIC will respond and what impact this will have on the wider financial system. For now, the bidding process for First Republic continues. The involvement of JP Morgan and Bank of America suggests that there is significant interest in the bank, and a successful sale would be a positive outcome for all parties involved. However, given the challenges facing the banking industry, it is clear that the road ahead will be anything but smooth.